The sweeping trade deal between the U.S. and 11 Pacific Rim nations announced Monday should boost the U.S. economy and lower consumer prices on some imports, experts say. The Trans-Pacific Partnership, which still faces the long, tough battle in Congress, covers countries that make up 40% of the global economy. This agreement is unlikely to be a game-changer for the U.S. economy in the short run, says Eswar Pradad, a professor of trade policy at Cornell University. But it could have significant net positive effects in the long run. That's because the U.S. currently imposes far fewer trade barriers, such as tariffs, than the other participating nations, providing the nation the bigger upside as those taxes are lowered or eliminated, Prasad says. For example, the agreement does away with tariffs as high as 59% on U.S. machinery, up to 70% on automotive products and up to 40% on agricultural products such as poultry and fruit. According to the White House, the deal will strengthen America's standing in the world and help our industry maintain leadership in the global market, says John Newfort, head of the Semiconductor Industry Association. And it would force the participating countries to comply with the same labor and environmental laws that bind the U.S., Prasad says, erasing a key cost advantage those nations currently enjoy. It certainly levels the playing field. The agreement also would lower regulatory barriers for U.S. services firms, such as financial and express delivery companies, says C. Fred Bergston, the senior fellow at the Peterson Institute for International Economics. That's a huge market in which the U.S. has a large trade surplus, in contrast to its yawning deficit in traded goods. Consumers should gain as well. Reduced tariffs on imports should cut prices by 5% to 10% for some electronics, clothing and auto parts, Bergston says. And an agreement to reduce the 12 years of U.S.